Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. As always, David, a lot of news to get to, but first, you were on the road again. Tell us where you went and what was going on.
Well, I actually went and had to go to a conference, but I stopped in South Carolina on my way to a conference in a very rough place to go, the Bahamas.
Cue the violins. Yeah.
It was actually interesting. It was a place called Baha Mar Resort, and I can't help but dig the numbers. This place was massive, Chip. The hotel and all its employees are 12.5% of the entire country's GDP.
Okay.
I thought that was fascinating, But anyway, so I stopped in South Carolina, got to visit with my mom and dad, who've been divorced for 50 years, but they happen to live together. That's another story. But anyway, in one of my properties. But I took my dad with me on this trip, and it was kind of enjoyable to get him to go see some of the people, see a little bit more like what I do when I'm on the road and what have you. And so it was so funny. Some people come up to me, "Hey, Mr. Brooks, thank you, blah, blah, blah." Something. I was like, "That's Mr. Brooks. I'm David."
Yeah. I saw a picture of you and your dad. He looks great.
So, yeah, he did pretty good. He's not as mobile as he once was, but I'm glad I got him out on the trip. So I don't know how many more he'll get to go on like that. So it was an enjoyable time.
But there was also a working trip now. What exactly were you doing?
So I was at what's called an advisor summit. It's just one of these general conferences that I attend every year, every summer, that is a lot of great general information about what's going on in our industry, what's going on in the economy, and, what to look out for. So, and unfortunately, what we're looking out is not real sharp. We've been talking about for a while, and this week, we tell you, we got hit with a barrage of news. Conveniently, you had Hunter Biden have someone testify against him on Monday, and so the next day, let's indict Trump again. So again, not leave politics out, but it's why we care is sometimes these things are distractions, because about 20 minutes after the Trump indictment, what really happened, the earthquake that happened this week, was the U.S. debt got downgraded, and I cannot stress enough how big of a magnitude and importance this is for people to pay attention to.
Well, let's go right there, David. Fitch Ratings is
one of the biggest rating services out there that rate our government debt, et cetera.
Well, and Washington Post headline: Fitch downgrades U.S. credit rating after debt ceiling crisis. Actually, CNN Business, you forwarded this to me. America's credit rating got downgraded again. Here's what happened the last time. David, you can throw out rhetoric, but eventually the numbers don't lie. You're a data-driven guy. This is economics. This is finance, and it's catching up with us, unfortunately.
Yeah, and unfortunately, right after the downgrade came out, within 5 minutes, Janet Yellen, the Treasury Secretary, came out and, this is wrong.
The Biden administration did not appreciate that.
Well, here's the funny thing is a little over a year ago, Fitch actually upgraded us. Now, it didn't change from AA to AAA. We were AAA, but we were AAA with a negative outlook, and they upgraded us to stable about a year and a half ago.
Okay.
And that was because the economy seemed to be coming out of COVID, right? Things were okay. They weren't great. But then we went crazy spending money all throughout the fall. And Fitch told us clearly, they said, listen, you need to get your spending under control, and you need to get inflation under control, or you're going to be downgraded. They told the government what was coming. They telegraphed it, and the government just went crazy. Our spending, Chip, is up 4% year over year, federal government, and that's just not responsible spending.
Well, the exact words from the report, and this is what raised the hackles of the Biden administration: steady deterioration in standards of governance.
Yeah.
Whoa, that's a slap.
Absolutely.
It's a body slam.
They don't care. And let's put this in perspective, folks. We just went through the debt ceiling argument. It doesn't matter, blah, 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 right? Just 2 months ago. Well, when they passed it, since they passed it, Chip, it's not been 60 days. $1.9 trillion has been added to our debt in less than 60 days. And they are now going to be adding $1 trillion a quarter to this right now. This is insanity. And so expect more downgrades to come, and this could have real havoc on our economy, our housing market, the treasury market, the stock market. This is very, very important that people pay attention to what's going on. So, and of course, you're right, Chip, I am data-driven. So to learn what we think may happen, what do we have to do? We got to look at the past.
Look at what happened. Well, that was the CNN Business headline. Here's what happened the last time. Can you summarize for us? What's the cautionary tale in that story?
Well, so the last time it happened, conveniently, it actually happened on a Friday afternoon after the markets closed. So the world had the entire weekend to kind of take it in, breathe, and think and how they're going to react. And you know what happened? The stock market got clobbered when it opened the next week. 6.5% down in one day. I'm trying to explain to people how big a drop that would be today. That would be cataclysmic if we lost 6% in a day. And of course, the morning of, the futures got hammered the next day on Wednesday this past week. The markets got clobbered right out of the gate. Not only that, you saw gold tactically go up for a short period of time. Back then, I believe it went from around $1,600 an ounce to $1,900 an ounce in less than 30 days. Now, we're not telling anybody what to do, buy. We don't make any performance-based stuff on this show. We don't make recommendations, but certainly you will see if the world doesn't absorb this for a short term, you will see the value of gold most likely appreciate in dollar terms in the near term. But what is interesting is the dollar last time did not fall off a cliff like people thought it would. You know, the dollar held in there and actually strengthened over time, and so did treasuries. They came back. So we'll have to see what happens here. But the problem is this is just, they're telegraphing, telling you cannot run a irresponsible fiscal house like this for much longer, or you're going to have to pay the piper. You're going to pay higher interest rates, and this means our government will have to spend more money, Chip, just to pay the interest, which is a problem today already with higher interest rates. And then we had this. We also had the Federal Reserve just raise interest rates again.
Well, how about that, David? CNBC headline: Fed approves hike that takes interest rates to highest level in more than 22 years. Now, some are saying, well, maybe the Fed's done. How do you see it, David?
Well, there's a high probability they are done at this point because they are now going to pause at least until September. So they're going to get a couple of job reports. This week we had an ADP private job report that was pretty strong, which is inflationary in nature, meaning they may not be done, right? And then we've seen a reacceleration of over 10% of inflation in commodities, which is input costs going into things. So inflation, in my opinion, is going to reaccelerate here over the next couple of months, not continue to go down. We're not going to go down and see this 2.5%. Some people are predicting, the talking heads on TV. I think you're going to see core CPI stay above 4% through the rest of this year and actually increase. And so the Fed may be pressured to go faster and further. But again, they're scared politically to do what they need to do. We've talked about before. If they would have ripped the Band-Aid off, they shouldn't have paused back in June, right? They should have kept going, and they should have moved faster, 50 or 75 basis points, not a quarter, because the longer they take, the less efficacious the reaction is and the longer it takes. And so they're going to break our economy, and the longer they stretch this on, the harder that break will come.
You wanted them to rip the Band-Aid off up front right away and get it over with.
Because we could recover, right? We'd go down, we'd go through a dip, 2-3 quarters, negative sentiment, negative economic news, job losses. And the other thing is now we're seeing earnings season where over 300 companies have reported already for this earnings season as of this week. And earnings are down about 8% year over year. Yet the stock market just was riding higher and higher and higher, and that's unsustainable. So we have so many things going on in the data points. I cannot stress enough, people need to pay attention because this means higher interest rates for government debt. In other words, people are going to demand you give them a higher rate. If we're less rated, the lower your credit rating, the more interest people expect to get paid. And with the amount of deficit funding we're doing, the government's going to need to get their hands on more money. If that's the case, what do you think that means, Chip?
Well, they're going to reach for it from.
Well,
they'll either raise taxes or borrow more or do some of both,
which is what they're going to have to do. Now,
Yep.
a lot of people aren't aware. Tax rates are already locked to go up in less than 2.5 years. You need to be proactive and understand what's going on in our tax system today, what's already on the books, regardless of what our current politicians or next set of elected ones do. You have higher tax rates coming in less than 2.5 years, and you can save money if you're proactive in your planning approach.
David, now, given what you just said, I'm intrigued because, some voices and commentators, they've been backing off in recent weeks on doomsday predictions for the economy. And but then comes this headline in Bloomberg: a $500 billion corporate debt storm builds over global economy. David, that sounds like the trailer for a disaster movie or something. And I know you're a little more concerned maybe than others are.
So
go ahead.
So several regional banks hold some of this debt, which is going to be an issue. But corporate America had kept borrowing and borrowing and borrowing, trying to borrow their way to fruition. And with higher interest rates now, corporate debt is not fixed rates. They're variable rates. They reset over periodic pieces of time. So now we're starting to see the default rate in this corporate debt increase. In fact, in that article, Chip, It talks about how the speculative grade companies, these are basically high yield, used to be called junk bonds. Basically, you're seeing 5.1% default rate expected next year, which was about 3% over the last 12 months. That's a 40% increase. That's monstrous in defaults. And if these companies default on the debt, who's backstopping? This is corporate debt, not government debt, right? So they go bankrupt, and you're going to see bankruptcies. You're going to see all kinds of collapse, which means job loss, which is the last piece of our economy falling apart. But yet that hasn't happened yet, although quietly you've seen earnings reported the last 3 weeks. CVS announced 5,000 job cuts. Google just announced 5,000 job cuts. They're starting to layer on. Big companies are laying people off. They're firing people. Small companies did all the hiring. We had a ADP private report come out Wednesday of this past week. 300,000 private jobs they were created, right? But 80% of those jobs, Chip, were created in restaurants and hospitality. Those are minimum wage or something like it jobs. It does not bode well for the economy. In fact, Chip, you have to look at our receipts for the government, right?
Okay, does that explain the chart that you sent me?
Yes.
U.S. federal tax receipts, you were asking the question, well, I don't get it. How can there be 2 million more jobs and so forth, but our year-to-year tax receipts are down?
Yes.
14%?
Yeah, so down 14% year over
because the jobs
year.
aren't very good, right?
Exactly. So
Okay.
if we have 4 million new jobs, as the current administration claims over the last year, you should have tax receipts up significantly. But tax receipts are lower because the good-paying jobs are going out the window, and the only jobs that are being created are part-time, as we've talked about. The jobs report all year long, over 500,000 of those jobs are people taking on second jobs. So we have the haves and have-nots. We have people that are going out there and hustling and working extra job to make ends meet to keep up with inflationary pressures, and we have people that are still expecting the government to take over and pay for everything. Now, again, I leave the politics out of it, but this is unsustainable, and it's going to be economically bad news. And industrial production is in recessionary numbers here. We've now seen Germany in a full-blown recession now. Europe is heading into a full-blown recession, and it's coming here, just a matter of when they actually call it.
We are in times of economic turmoil, but don't panic. Get the complimentary report card. 402-369-7777. Comprehensive review of your entire financial situation, and we recommend what you might want to do going forward. No charge, no obligation. 402-369-7777. That's a complimentary report card. 402-369-7777. Up next, David Brooks is great, but it takes a team to do what we do at Retire Smart. We welcome back to our show a vital member of that team. Financial advisor Mike Schudel is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Our special guest this week is an experienced financial advisor who also is an attorney, a certified financial planner, and he's taught finance classes at Creighton University. He's our go-to guy on estate planning, and we're glad to have him back for another visit. David, please introduce our special guest.
Thank you, Chip. Yes, once again, we have one of our most experienced advisors in the studio this week, and who's got a gazillion letters behind his name. Mike Schudel, thank you for taking time to jump in again.
Thanks for having me.
So we've got another estate planning class. These have become very, very popular. That you, and along with Colin Kastrick, one of the attorneys that we refer a lot of people to for estate planning, you don't actually write the plans. You help craft them.
Right.
But you do have a law degree, and so that's one of the reasons you found kind of this to be one of your favorite classes to teach, as I understand, right?
I do enjoy that. Absolutely. Have an affinity for teaching and getting to speak on something I've got a lot of experience with.
Well, let's talk about, how crazy the estate world can be. So you're a little younger than I am, Mike. We know that. But, I'm sure you know who Aretha Franklin is, right?
Yes, indeed. Yep.
Queen of Motown. And, she died and had a massive estate battle on her hands. And just recently, they found a handwritten will
Oh, boy.
in the cushions of her couch. And that was determined that was the most up-to-date and accurate will. And so it's changing who's getting what with an estate plan. I mean, that's just... And we're talking about obviously not a minor estate here. Her royalties,
Yeah.
I can imagine, is quite large.
Well,
et
there's
cetera.
great legal precedent that you put all your most important documents in your couch cushion. So it sounds legit to me.
So what I want to talk about is just how often people should, because this brings up the point. She obviously changed her estate plan. Whether that was first or second, I don't know. You know what I mean? But she changed her estate plan. And that is something that you're passionate about. People need to understand. You don't just create an estate plan. Okay, I've got it. Put it on the shelf and collect
No.
dust, right? Yeah, you have to actually proactively look at this typically about every 3 years as your net worth grows. The beneficiaries
Yep.
may change. You may lose a loved one that predeceases you that you intended to leave stuff to. And you've got to make sure you're making changes to your estate plan so that the assets and the resources and the things that you've accumulated over your lifetime go to who and where you want, right?
Absolutely. And the law is constantly changes. Watch this. Currently, anybody this year can die and leave $12.92 million to any loved ones and not trigger any federal estate taxes.
Unfortunately, here in the state of Nebraska, you will trigger state inheritance
Yes,
taxes.
you will. But that number goes from 12.92 million. It's scheduled to go down to 5 million on January 1st, 2026. That is a tectonic shift. That is more than 50% change. Do you think that that's something that might impact a person's will and trust plan?
Well, not only that, it's people to understand it's not just like your IRA or your investment accounts. It's your house. Maybe you've got farmland in the family, and maybe life insurance, the death benefit that is paid out tax-free to your
Right.
beneficiaries.
It's all included.
That's all included as part of your estate if you, in fact, own your life insurance. And that's one of the things you talk about during the class is, hey, you might not want to actually own your life insurance, even though over 99% of all policies are typically owned by the insured. We usually think that's a mistake. So you sent me an article. I thought it was a pretty fascinating read. I believe it was from Forbes that just talked about the importance of understanding just what we're talking about, having a living, breathing estate plan that's ongoing and changing, especially in, I believe the article was titled Planning in Uncertain Times, and it talks about all the varying changes that go on. So talk a little about that article, if you would, and what the kind of the headlines that stuck out to you.
So times change, and unfortunately, we are probably looking at some pretty serious changes in the financial climate that we're in. The markets could be going down, things could be moving and shaking a little bit here. Just gritting your teeth and bearing through it is not a plan at all. Having an advisor, both somebody on your team that's helping you manage your assets and a estate plan attorney that's helping make sure that your plan on how to distribute those assets once you're gone are proactively looking for opportunities to take advantage of these changes in the market. If assets are depressed, maybe that's a great time to shift them into a Roth IRA for yourself, maybe shift them into a trust for future generations. These uncertain times are going to be here whether we like it or not.
Well, let's talk about that for a moment. So obviously estate planning, and we talk about this on the radio all the time, it's for everyone. This is not, you don't have to be uber wealthy to need an estate plan. Now, certainly the higher the net worth, the more sophisticated typically the plan is going to be. But there's a lot of Americans that are now worth that $3 to $5 million range just because we've had healthy markets for 2 really plus decades, and net worth has increased drastically in the U.S. over that time period, and so people accumulate land, rental properties. I mean, I've done it, and you all of a sudden you end up with an estate that is actually getting a lot larger than most people think they have. I mean, how many times we have people walk in and they have $3 million and they won't spend $50,000 a year, and they think they're going to run out of money. We have to give them confidence that that's probably not going to happen. We can show you that with some math. But the estate planning portion, I think, is so critical because you mentioned earlier the estate exemption. It's not top of mind right now because you can exempt so much. A married couple can exempt almost $25 million basically. That is going to drastically change. And here's the one thing I think. We talked about in the first segment a debt problem here in this country. We've had our debt downgraded. We're going to have, folks, this is by my numbers, $50 trillion deficit. The government will owe this kind of money in just about 10 years.
How do
they get it back? Well, the easiest way to tax people, the lazy tax, if you will, is a death tax, otherwise known as the estate tax. And states, by the way, may be doing this too. So make sure you pay attention to your state legislatures because all these governments are going to need revenue to continue to pay all these promises they made when it wasn't their money. And so this is so important people understand. There are proposals. Biden's proposal wanted to take it all the way down to $1 million at one point, $3.5 million in his most recent tax proposal, which was in the budget he actually proposed for this year. Now, it didn't go anywhere. But here's the problem. It is very likely that this is where the right side of the aisle will cave on this issue typically. And again, leave politics out. We care about the policy. I don't care about the party or the person. It's the policy and how it's going to impact our clients here at Retire Smart. And so this could be critical, Mike, right? So if they give in and take it down to 3.5 or 1 million even, this affects a vast majority of baby boomers.
I just can't emphasize enough. If it's 1 million, I bet that I can't hazard a guess. So many people will fall under that tax. And right now, the current tax rate, if they did take it down to 1 million and maybe you had a $2 million estate, David, you know the answer. What percentage of that extra
45% they're going to take, right? So
Yeah.
450 grand in that example would go to the federal government just in an estate tax. Now, imagine you have a family farm, 640 acres, and it's worth 10 grand an acre. That's 6.4 million. This is where the assets are that people don't realize
Yep.
at the valuation here and how they're going to get stuck. And farmland's going up, right? And it's continuing to
Absolutely.
go. They don't make it anymore. We've seen record prices in Iowa and Nebraska this year, well over 25,000 an acre on some parcels. So think about the value of what that land would be if you have some in your family. And that could push you into not only an inheritance tax here in the state level, but an estate tax on the federal level. And you can, and you mentioned earlier, you could pre-give some of those assets in a trust at the value now,
Yeah.
right? And gift it out of your estate, and then you don't have to worry about the future value of it when you pass. And a lot of people don't know that's even possible.
Exactly. So, yes, while we've still got these larger amounts that we can give away, now might be a great time to do it. They are not going to come claw that back, even if they reduce the federal state tax exemption. Once that gift is given in good faith under current tax law, it's a sound gift. There's no legal precedent that they are going to come back and change that.
So listen, it doesn't matter if you have a $500,000 estate, a $5 million estate, or a $50 million estate. You need a proactive estate plan that is going to adjust and adapt based on current legislative risk, right, market risk, asset levels, and the current geopolitical environment that we find ourselves in, and we can adapt and adjust your plan. Just since 2017, there's been like 6 major pieces of legislation passed, both on the state and federal level, that have affected our clients, and we have to be able to adapt and adjust. So if you've not reviewed your estate documents in 3 years or more, I would highly encourage you to sit down with your advisor if you have one. If they're a fiduciary, they should be asking for this stuff anyway.
Yes.
But if not, and you would like a complimentary review, we will have our attorney, Colin Castrick. Now, when I say our attorney, he's just affiliated with us. He's not part of our company. He's his own law firm, et cetera. But he's competent professional in our humble opinion. We would love to have, he lets us offer you a complimentary consultation to review your docs. But I'll do you one better. Colin and Mike here are going to be teaching a class where they go through the ins and out of estate planning. This is when is this next class, Mike?
Yeah, we're having it here at our office in the Midwest Learning Center at 6:30 p.m. on Wednesday, August 16th or Thursday, August 17th.
And what time is that at 6 p.m.?
Yeah, again, 6:30 p.m.
Okay, so all you got to do is call to get registered for that, 402-369-7777 to get registered for that class. This one does fill up. We had to actually bring extra chairs in last time. We had about 60 people attend. It is a very, very popular class. Now, here's the other thing. If you're one of our longtime listeners out there, I'm going to hand you one of my favorite documents. I talk about it usually around the holidays. When you come to this class, we will complimentary give you what's called the Smart Document Checklist. So this is a financial inventory that really helps when you go to an attorney or a financial advisor or your tax professional to just give them a lay of the land. We've created this one simple document. If you've never heard me tell the story, unfortunately, my wife lost her brother the first year I was married at a very young age, and I had to go through this process as a much younger version of me over 31 years ago, and it was not fun. And so this simple document, we've had many clients thank us over the years for having this.
Yes.
It kind of helps organize things, if you will. So even if you don't have the greatest estate plan, you can at least know where everything is and try to get your ducks in a row. But I really encourage you, come to this class. Mike, I know we're already out of time. It goes fast here, but thank you for bringing that article. By the way, we'll post the article on YouTube in the show. So if you'd like to read the article, Planning in Uncertain Times, we'll have that. And Mike can get you a copy of that when you come to the class if you request it as well. Any other tidbits you got for us this week, Mike?
No, I really appreciate having me on, and certainly looking forward to teaching this class again.
All right. If you want to get registered, 402-369-7777. Thank you, Mike. Chip, what do we got next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about healthcare. WalletHub did a study of the states with the best healthcare systems. Nebraska was number 14. Iowa was number 2. Our other neighbor states were all in the top 16. As I approach age 60, I sometimes think of a warmer climate for retirement, but access to good health care might be a reason to stay in the Midwest. Am I overthinking it? Well, David, the M in a smart plan stands for medical and health expenses.
So they rated Iowa number 2 in the quality of health care given, right? And Nebraska was top 15, number 14 there. But you also need to factor in, Chip, the cost of that health care. And Nebraska actually is very well suited in the cost. The last survey I read, we were the second best for senior health care in particular. So, yes, when you're looking to retire, a lot of folks, just like you, think, well, maybe a little warmer climate might be nice. And so we have people, when we talk about taxation, that's one of the issues that drives people to want to retire elsewhere, right? They don't pay the property taxes, outrageous property tax here. They don't want to pay income tax anymore. Well, the good news is income tax is coming down. It's not zero, but it's going to be basically 4%, 3.99 here in just a couple more years for the state level. And we're not going to tax your Social Security or pensions anymore. So those are good, headlines there. But you have to look at the total retirement picture before you were to make a decision based on moving just on a cost item. So if you want to be in a warmer climate, that's what makes you happier, then that's where you should be. But if you're looking at the numbers as we do, we have to dive in. And I talk about this often. I had somebody that was looking to move down. They were in the Fort Lauderdale area. They went down there for vacations. Their daughter lives in that area, just North Miami area. And so they thought, it'd be nice to be in a tax-free state. But we just looked at their Medicare coverage and the policy cost, right? The exact same company, this is the same A-rated carrier, nationally known carrier you would know. The exact same policy from here was $110 a month. It was $389 a month there.
Why?
Because it's based on reimbursement rates of the hospitals, et cetera. That's how Medicare premiums for the supplemental policies are priced. So it's a vast difference. And so while they would save, in this example, that couple was going to save about $4,000 in income tax and about another $2,000 in property tax, apples to apples. So they're going to save $6,000 in taxes if they made the move, but they were going to have to live in a house 1/3 the size, right? So the downsize to make it apples affordability for the square footage where they were going to go. And their healthcare expenditures were going to be like $9,600 more there. So it was a net loss. The total cost loss was over $15,000 a year in all things that we factored in. So again, they had the means, and they're still deciding if they want to do that. We want you to live the life you want, have the retirement you want, but you need to have someone that focuses on more than just, hey, what stocks are we buying, or what mutual funds are you in? You need someone that's doing a true retirement plan, a holistic retirement plan that looks at the 5 key areas of a successful retirement. And that's why we developed the proprietary smart planning process, so that we can look at everything from your Medicare expenses, your estate plan. We just had Mike on the show talking about that, to when you should turn on Social Security, to the tax that you're going to pay throughout your retirement. What taxes can we eliminate or reduce or mitigate, and the risk management of your portfolio, the asset allocation, legacy plan. There's so many factors that go into a true holistic plan. So it's a neat, these surveys come out. By the way, Iowa just ranked in another one this week. I forget where it was. I don't know if it was NerdWallet or whatever, as the number 1 state to retire, and beat out Florida on a total evaluation. And again, Iowa's been working hard to get the cost to live there on taxation. Governor Kim Reynolds has done a great job there. And so, keep that in mind. Maybe you only have to move across the river and then just, Airbnb when you want the sun. I don't know.
Okay. Hey, the next question is about currency. Oh, I've heard this ad on the radio, David. The questioner says, former Trump guy, Steve Bannon, has an ad on the radio saying Russia and China are going to introduce a new currency that will jeopardize the strength and standing of the dollar. That sounds ominous. Is it true?
No. Plain and simple. So this is rhetoric to sell you a commission-based gold account from an unlicensed endorser, and these are nonstop. Get your gold IRA, and there's Stephen Bannon, other guys, tons of them out there. I cannot stress this enough. There's nothing wrong with gold and silver. In fact, I just talked about it. What happened the last time our debt got downgraded? Gold made a nice move tactically, but people are going to not be able to time. When you have physical gold, you're not going to be able to go haul it to the store and sell it on the day to get peaks. So we use gold as part of the allocation in most of the portfolios to hedge against things like this. But gold is simply a hedge against the currency that you're buying or selling it in. In this case, for most people listening, the dollar, right? And so if the dollar gets weaker, gold gets more expensive, and vice versa. But this is just fear mongering here to tell you the currency. The world is not going to accept the Chinese yuan as the reserve currency, period. Not unless they let it float against other currencies around the globe. They
When
do not.
When you say reserve currency, this is the default currency used in international transactions.
Yes, certainly there are people, BRICS, and other countries
And it's the
trading goods and services outside the dollar. So we went from 5 years ago having 71% of all the world's transactions in the dollar, all cross-border transactions, to now it's just 68%. That's not a big drop. Certainly it's a drop. But the chance that we go below 50% in the next decade or so is slim and none. You have to understand is the dollar, there's too many people dependent on, and China is dependent upon the dollar. You understand how much debt they own of ours. If the dollar went away, they would lose out mightily, and China is struggling mightily right now. Now, what is not mentioned here is you realize that Russia is selling gold to China at a 30% discount. How desperate is Russia? If you have an asset that's supposedly this amazing asset that is going to why would you sell it at a 30% discount?
Fire sale prices.
Yeah, because they are desperate. Russia, that's the reason they're at war right now. Their economy is going to collapse if they don't come out on the victorious side of this war, because oil is the only commodity they have right now. And so that's why they annexed Crimea. That's where the grains are grown, right? And so they are trying to control food supply, and they're losing badly economically anyway. So yeah, if you want to talk gold, we're happy to explain that to you when you're in with a visit with one of our advisors, how you can have gold in your portfolio. But physical gold is very expensive. There's many rules. If you do it in an IRA, most people mess it up and end up getting a massive tax bill later.
David, the next question takes us back into the discussion of deficits and debt management. I saw a story at MarketWatch about the federal treasury preparing to borrow $1 trillion in the fourth quarter, about $300 billion more than initially expected. Then the story talked about the connection to another debt ceiling crisis brewing at the end of the fourth quarter, but my brain started overheating. I feel like I should be concerned about this, but I can't put my finger on it. What is happening, and what does it mean for those of us trying to build a solid retirement plan?
So it means interest rates higher for longer than most people want to realize, because it's inflationary pressures by the government continue to create money basically out of thin air. It also means we are burdening future generations with a debt load that will be insurmountable. And so it means increased taxation, way beyond what's most likely on the books. We just talked about this the last section with Mike in the estate planning class, that, look, we do all of our planning, tax savings, estate planning on current law, but we build flexible and adaptable plans to adjust to the legislative risks or the geopolitical risk of things like this happening. Right now, our government is spending money wildly out of control after they just promised, we just get this debt ceiling hike, we'll be good. As I just mentioned, $1.8 trillion added to the deficit in less than 60 days, and the plan is to add another trillion per quarter for the foreseeable future. And if we don't do anything, Chip, if we had not one new dollar of government spending, not one COLA raise on government workers, any of that, we will have $47 trillion of debt by the end of this decade.
Mind-boggling. Well, that's why Fitch is downgrading the USA.
So what you can do about it is get proactive and learn how to protect your assets and get them into tax-free accounts or tax-advantaged accounts. Most people, Chip, over 90% of the average American's net worth, where they save the retirement dollars, is in a tax-deferred account, a 401k, a 403b. Folks, you can be proactive. You can take advantage of the lower tax rates that are available today by following the rules. The government is actually incentivizing you. There's actually incentives right now in the tax code to prepay your retirement taxes early, so that you don't have to pay a future tax that could be significantly higher as that debt accumulates. And it's up to you to take action. And this is one of the things that we show you. We actually have a federal trademark. It's called Strategic Roth Integration. We'll show you how to maximize the efficiency of moving money from the wrong tax bucket to a better tax bucket, whether it's a tax advantage bucket or a tax-free bucket, depending upon your situation.
David, we're out of time for Q&A this week. How many openings do we have in the calendar if people would like to schedule a 15-minute phone conference with one of our advisors?
We have 6 of those available this week. So, folks, take advantage. Find out what's going on. What does it mean to you, the debt ceiling? What is your risk in your portfolio? What tax savings may be possible? Whatever your questions are, we'll schedule this is a scheduled time. You can ask them anything you want. There's no obligation whatsoever.
402-369-7777. Call to schedule a 15-minute phone conference with one of our advisors. 402-369-7777. Up next, a family-owned business cost itself $1 million because of an estate planning error. We'll tell you what happened and what should have happened next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, we are going to get eventually to that story about the estate planning mistake for that family business. But first, you sent me a couple headlines about something that happened recently. Here's the CNBC headline. Teamsters, of course, is the truckers union. Teamsters says U.S. trucking firm Yellow shuts operations to file for bankruptcy. And then right on the heels of that was a New York Times story. After $700 million U.S. bailout, trucking firm is shutting down. Oh, David, the shutdown is bad enough, but the wasted bailout money is salt in the wound.
The government should not be in private enterprise and vice versa. Anytime they stick their thing, you can't pick winners and losers. There's just example. I mean, remember Solyndra, $500 million of government money went to
the
them
energy
back
company,
yeah.
alleged
Yeah.
energy company.
Yeah. So here they were basically bailed out with a $700 million loan from the federal government in exchange for, I think, 30 or 35% of the company. The government was going to, if you remember, Lee Iacocca was the only one that ever actually borrowed correctly. Remember when he saved Chrysler way back in the 80s, the government bailed him out, and he actually repaid him well ahead of schedule. He had a real plan. Here, the problem is they're dealing with union labor. And again, not pro or con to unions, just talking in general here. The union kept demanding more and more of them, thinking the government would continue to backstop them. The government's not going to backstop them. And as they were trying to get through the tough period, the COVID, the shutdown, obviously supply chain problems, you can understand why trucking companies struggled for a bit. But then we had trucking just a year and a half ago was at its peak. I mean, you could get the max per mile. My nephew owns a trucking company, and it's fallen off a cliff. When I was just visiting in South Carolina, we talked at the beginning of the show, that's where my nephew is. He owns a trucking company. The rates are down 45% year over year for what trucks can get, per mile is how they typically get paid. And they either get paid direct from the company that wants them to transport goods, or they go through what's called brokers that can take a piece of that. But so the problem here is Teamsters is yelling that they didn't manage it properly, where the company, which used to be YRC, Yellow Trucking, is the stock. It was a penny stock, then it went way up, and now it's gone, basically bankrupt. They said they've never seen demand fall off a cliff like this unless there was a major recession on the way, which is, again, a telltale sign of where we're going, right? Not where we've been. They're not having demand to move goods and services, and so what it means is 30,000 people are out of work. 30,000 jobs here. And we gave them a $700 million bailout that just went out the window, right? So that's like you could have given each one of those people about 40 grand of unemployment assistance for the same check. You know what I mean? It's mind-boggling when you start to realize what's going on here and how bad the economy may end up. And again, the further we go until these Band-Aids are ripped off, the worse it's going to get. And to act like you can just keep printing money and bail companies out and there's not going to be any repercussions is ludicrous. And so this is not good news. This is not good news for the drivers. And listen, truck drivers are America's backbone. Blue-collar guys that get it done. They're on the road. Some of them miss their families for weeks at a time. But that's how America fuels America, right? Is businesses need goods and services to be able to sell. And if we don't have an active trucking industry that's doing well and healthy, that does not bode well for the economy in general, because it means less goods and services delivered to your favorite retailer, store, restaurant, etc. Bad news all the way around, unfortunately. But it's another realization that the government should not try to pick winners and losers. If they were going to fail, they should let them fail, because another trucking company would have swooped in, bought their assets, bought the trucks, hired the drivers when demand returned. You cannot predict winners and losers with government dollars. It simply doesn't work. And again, now we find ourselves, this is part of the just money being spent out of control with our current administration and the previous administration. Let's be fair here. This was done under Trump, okay? But the government shouldn't be picking winners and losers, period. So you should be calling your congressman or woman, senators, et cetera, and expressing, stay out of private industry, regardless of political affiliation. Let the free market set it. Just go back and read anything by Milton Friedman. You'll learn how economies work. I still love the video on, how a pencil's made, if you've never watched it. It's a great YouTube video. But anyway, more bad news is on the horizon. There's going to be more companies laying off. We're seeing trucking companies go under left and right. 400 trucking companies have gone out of business this year already, smaller ones, private ones. And So, and the good thing for my nephew, he's actually in a niche market. He does, I think they're called RNG trailers, the ones that move like the big caterpillars and bulldozers, the
Okay.
trailers that between the legs
Yeah.
go down. It's a very unique niche market that his trucks operate in. But anyway, this is not good news for the jobs, the economy, the government. Bad news all the way around. So pay attention to what's going on in the economy and protect yourself.
Well, speaking of paying attention and protecting yourself, in the time we have left, David, here's the headline from the website Rethinking 65. A planning oversight costs a family business $1 million. And the sad thing is, David, this could have and should have been avoided.
We actually talked a little bit about this earlier. So what happened here is this was a family company, and there's so many mistakes made. And by the way, if you are part of a family company and you're at some point looking to do the transition, from one generation to the next. So I have one of my boys that works here at the company, does some research work for us. He has no desire to be on this side of the aisle. In other words, the client-facing side. My other son doesn't want to be in the industry. So I don't have a kid who wants to come take over dad's company, if you will. So my plan is for the employees to purchase the company at some point. But through most likely through an ESOP, one of the tax strategies we implement. But anyway, this was a family business that done really well. They'd done the right steps, Chip. They went ahead and planned this out. They had the company purchase some life insurance, right, to help pay the taxes on the transition. The problem is how they titled it and who owned the life insurance, and the IRS was able to successfully argue that a $3.5 million death benefit was included in part of the estate. And so therefore, we talked about it earlier. Now, if they would have put this life insurance in a properly designed trust, they titled it properly, they set it up properly, and reacted to changes in the law, this $3.5 million would have gone tax-free to the beneficiaries. But instead, it was an additional $1 million in federal estate tax and attorney's fees that had to be paid because someone didn't relook at the plan. You cannot create an estate plan out of thin air, sit it on the shelf, and then just, I'm good. And we do this all the time. We'll ask clients when they come in for what we call a vision appointment. This is just where you come in and kind of, you find out a little bit about what we're about, and we try to find out what your concerns are, and that's it. That's all that really happens in that first meeting. And one of the things we'll ask is, do you currently have it? Oh, yeah, I've got all that taken care of. Well, if they happen to move forward in our process and a couple of months later we're meeting with them and, tell me about your current estate, or, I wrote it in 1992 before I had kids, and I'm like, that's not an active estate plan. So the class we have coming up would be a great opportunity for anyone that's got an outdated estate plan, doesn't have an estate plan, or just wants to understand how to transition assets. And by the way, that's what TaxSmart and Abigail works through here. With one of our affiliate companies, is helping business owners understand how to properly design and transition companies from father to son or father to daughter, kids, etc., or even how to sell it outright if you're not going to be the one, if your kids don't want to take it over, but you still want to preserve the assets like I do. At some point, I will want to take equity off the table or something in some point to preserve assets for my family, right? So all this is the proactive planning that we can help you understand how to do so you don't make these kind of critical mistakes. I mean, just think about this. If someone just went back and reviewed this, Chip, that's $1 million. And the argument some people make, well, I don't want to pay the attorney, $500 or whatever it would have been to review it. I'm like,
my goodness.
Can you think
an
about
ounce of prevention?
Yeah. So think about the ROI on that. So,
Yeah.
If you're one of those people, like, I just never paid for advice, or I've never, well, it's probably costing a lot more than what you think you might pay for a professional to help you out. I don't think surgeons should operate on themselves. I don't think lawyers should defend themselves. And I don't think people should be doing their finances on their own. Get a competent, experienced professional and find somebody you're comfortable with. Does not have to be us, but I cannot stress enough, I believe you should work with a fiduciary-based, independent financial planner that will do a true holistic look at your plan, and that's what we believe our SMART process does.
Well, and estate planning is an important part of that SMART process. We've got some seats for the next round of workshops right here at the Midwest Learning Center at Retire Smart, 6:30 p.m., Wednesday, August 16th, or Thursday, August 17th. No charge, no obligation, but we need to know that you're coming. 402-369-7777. You do need to register. Clients, of course, are welcome. So is the general public, but you must register by calling 402-369-7777. And, of course, the tax planning guide is there, a 15-minute phone conference. We got 6 of those this week, and the comprehensive report card. All of that, no charge, no obligation. 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week. We'll see you at the next class.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.